Good morning, folks. It's 9 o'clock. Time to go. I know it's payroll time and short week. So, yeah, let's get cracking. For those of you who do not know me, my name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk. So I look after the PAYE, UIF, STL, ETR, Workman's Comp space. Been working in this space for almost 30 years, and I'm on the board of the Payroll Authors Group. I'll talk a little bit about that later on, but yeah, quite interesting place to be because I'm at the cutting edge of what's happening in payroll. But today what we're going to do is we're going to look at a few of the budget issues. We're going to go over what's happened in the last year in all of the spaces that I've just mentioned. And I'm also going to just chat to you briefly about some challenging areas where I consult on a regular basis and where there is limited or very little understanding. We'll also look at a little bit about SARS, but it's quite a lot to fit in. I think there's 70 odd slides to fit into an hour. So I need to keep it quite concise. What I'll do is we will unmute everyone at the end, and people will be able to ask questions. But also, I would be very happy if you sent me emails and I could respond, or you can phone me. You're welcome to phone me. But let's get cracking. Okay, so the first slide, just showing some tax tables, and as you'll see, the left hand mirrors what the right hand side of that screen is. So by now you should all have known there's been no changes to tax tables. Some people might think that's good, some people might think that's bad. So for the first time in a long time, the brackets have been adjusted to cater for inflation. Because the brackets have not been widened, the issue of bracket creep comes in. And what that effectively means is if your earnings in 2024 tax year were near the top of one of those tax brackets and you get an increase in this 2025 tax year, you potentially can go up into the next tax table and pay more tax. Obviously, that's going to water down your increase significantly. Now, previously, the finance minister would increase those tax tables, make them a little bit wider, so that when you got your increase, it didn't push you into the next tax bracket. But no can do for this year. There was no changes in the marginal tax rates of each of the bands. So the lowest rate stays 18% and the highest rate stands 45%. Very, very hot topic, you know, in an election year. So we didn't really expect the finance minister to stick his neck out and punish the high earners by increasing that 45%, because it not only alienates those earners who are the main contributors to the fiscus, but also can lead to money leaving our country. This slide just shows, as I said, the exact same mirror 23-24 to 24-25. The only thing I want to bring to your attention is the challenge that we've seen with tax coming in at the rate of at 95,750. We're starting to see more people fall into the tax bracket. So you might have employees in your company who were earning just below that, who are now earning just above that, who are going to come crying to you to say, no, the tax tables didn't change, okay? And you're going to have to say to them, no, they didn't change, but unfortunately, you've gone over the 95,750 and you're now paying tax. Whereas if that had gone up at inflation, those employees would have still stayed out. Another bone of contention was the medical aid tax credits. And as you can see, those have stayed the same. I think it's Well, I was pleasantly surprised to see that they hadn't been done away with, because the talk is these are going to be done away with as a step towards funding the dreaded NHR, National Health Insurance. So those are in there still, but as you can see, they haven't changed. So there was no inflationary adjustment for those credits. We did see an increase in the travel reimbursement rates from R4.64 to R4.84. So that is in line with inflation. And then the deemed expenditure tables, which I have listed there, those were also slightly adjusted to deal with inflationary expenses in vehicles, fuel, and maintenance. I will discuss this a little bit more shortly. Subsistence allowances were also adjusted. So the daily rate for incidental expenses went up to R169. And that doesn't necessarily require you to travel overnight as of the 2022 tax year. If you have an employee going out for the day to see a client and there is travel involved, you can pay them R169 to cover incidentals without there being a tax implication. There is a reporting requirement in payroll still, but no tax. And then the rates per day or part of a day for meals and incidentals went from R5.22 to R5.48. And you can obviously pay the employee that rate without levying tax, and the employee has no reporting requirements. So it's just a rate that SARS say to make things easy, give your employees that rate, and there's no reporting requirements. SARS interest rate, I've just put this up for interest. If you've lent an employee money or there's some sort of a loan in the payroll, the SARS rate of interest that is required to be charged before there's a fringe benefit is 9.25%. And then, as you can see underneath that, if SARS owes you money, you get 7.75%. If you owe them money, you're paying 11.75%. So obviously not equal. So yeah, the moral of the story is do not owe SARS money. That gets adjusted as the repo rate changes. In terms of your companies and trusts, your company tax rates was announced 2 years ago that this was going to change to 27%. So it has, but trusts remain 45%. Small business corporations, the tax tables for small business corporations remain unchanged. Just to remind you, the small business corporation is an entity trading with turnover under a certain rate, with directors who do not have interests in other entities and work in certain industries. The micro business tax tables also haven't changed, and neither has the transfer duty rates. The one challenge here is the 1.1 million. Normally we see that increase in line with inflation, so that as you can understand, anyone purchasing a house 1.1 million and below is not paying transfer duties, but that remains unchanged this year. So you're going to have more properties going over that 1.1 million who are now going to fall into the transfer duty pool. ETR calculations, ETR bands remain unchanged, and they've been unchanged since on March 2022. I think that's a good thing because yeah, this complicates things significantly for payroll and interpretation if they're changing all the time. SARS seem to think that the ETR process is working, so they're keeping them stable. Just a reminder that your employees in this ETR band only, well, the employers with employees in this band only qualify for the benefits in 24 months. So if an employee meets the qualifying criteria, that counts as a month. Whether the employee claims is irrelevant. So don't miss months where you eligible to claim. And ETR, if it's not claimed in a qualifying month, it can be claimed in the next month, providing it falls into the 6-month reporting cycle. And as I've said here, getting out of sync in terms of qualifying periods and claims can result in a SARS ETR audit, and I urge you to avoid that at all costs. Issues to note in the ETR space is SARS are looking obviously at paying close attention to who is on the scheme. Are they real employees? And I've said some of the training schemes out there are problematic. And what I'm meaning there is when this ETR came into force, over time, people have got smart and seen the opportunity to abuse the ETR system. They've seen loose threads and they've pulled at these threads. And we've seen a lot of our clients approached by third-party companies to implement some sort of a scheme that would qualify them to claim large amounts of ETR. And a lot of those schemes are problematic because who the employer is not clear. And when you dig deeper, multiple organizations are utilizing these ETR benefits illegally. So SARS will look at where the employment relationship lies, where the paperwork lies. They'll look at intention. And we've been told that there's 300 cases on appeal currently, 308 cases on appeal. And I am aware of certain companies that have had to pay millions when these types of cases have been challenged. So there are punitive measures out there, and there's more audits. SARS have got AI tools, and they are identifying movements and irregularities. So don't be selfish or greedy and abuse the ETR system. I've included the next couple of slides just to show you from a payroll perspective where you should be doing checks when you turn over to the new tax year. You can read these in your own time. Just quite interesting as to where your payroll company's responsibility is and where your responsibility is. So those 3 slides, please look at in your own time. I'm going to move on to quite a topical issue now, and that is the 2-pot retirement system. And this has been mooted for quite some time. I have done quite a lot of articles in our newsletter on this issue because it's been hotly debated, and because you've got multiple interested parties, there's been certain amount of horse trading before the implementation of this process. And I actually think there might be some tweaks as we go forward. But as you can understand, you've got taxpayers out there, your employees who are desperately trying to get hands on some of their retirement money so that they avoid loan sharks. You've got the employer that's stuck in the middle, and then obviously you've got the retirement fund. And the retirement fund has been pushing back significantly, saying that this process requires a lot of programming and training. And then you've had unions bleating about the fact that their members need access to money. And you've got the government also in the middle there, somewhat trying to keep the taxpayers sweet because we're in an election year. So there has been a lot of backwards and forwards, but the retirement funds had hoped for 2025 implementation. The unions wanted 1 March 2024, but we've sort of settled in the middle. So this 2-pot system is going to come into into play on the 1st of September 2024. So I don't think September will be the busy time. I think October, when all the claims come in, is going to be problematic. So, in terms of this process, retirement fund contributions, the deductibility thereof is going to stay the same. You're not going to see any changes. Employees are still going to be able to deduct retirement contributions, up to 350,000 or 27.5% of their taxable income. So as I've said, that's unchanged. Any withdrawals prior to 1 September from a retirement fund will be subject to the same rules. Now, remember, you've got two tables here. You've got tables for those people who are under 55, and those tables are quite penal because obviously you're not at retirement age yet, and the exemption is only 27,500, and then you're going to pay tax on your withdrawals. So I urge you not to go down that road. Your money's in this fund for retirement, and it has to grow. So don't touch it. And then if you're over 55, there's a set of tables that allows you to get an exemption on the first 550,000, and that is assuming you haven't had any retrenchment payments. So hopefully when you get to retirement age, which is 55 and older, you can make use of that 550,000 exemption when you're pulling your 1/3 out of the fund. So as I've said, any withdrawals prior to 1 September are taxed according to the two lump sum tax tables. Now, I'm going to introduce you to the 3 pots. Although it's called a 2-pot system, there's effectively 3 pots. And the word pot is apparently offensive or confusing to certain people. So we've been urged to use the word components. So the first pot or component is effectively going to be your money that you have saved up until 1st of September 2024. Remember, as I said, you can only access 1/3 of that on retirement, and 2/3 has to be taken out as an annuity. We're then going to have this savings pot or component that is in place after 1st of September, which will be accessible. And 1/3 of all contributions after 1 September are going to go into this pot. And then obviously you've got your retirement pot, which is going to have your other 2/3, which you're not going to be able to touch. Now, I still think having access to 1/3 is problematic, but the financial situation of the majority of the citizens in South Africa is problematic. So just to go over that again, the existing pot is whatever you've saved up until prior to the 1st of September. Then you've got the savings pot, which going forward is going to have 1/3 of your contributions. And then you got the retirement pot, which is having the other 2/3. Now, there has to be some sort of a seed capital in this fund to start with. So what SARS are going to allow is 10% or 30,000 to be transferred to the savings pot to just start this process. It's interesting to note that you'll only be able to make 1 withdrawal a year with a minimum withdrawal of 2,000. It's important to also note that there is going to be costs associated with this. So the funds are saying, if you're going to withdraw 2,000, the costs of the process are going to negate any benefit you're going to get out, bearing in mind you're also going to pay tax. And the maximum will depend on what is in pot 2 at any one time. So remember, pot 2 is going to start with 10% of all 30,000. And then as you contribute after 1st of September, 1/3 is going to be able to go into that pot. And the pot can be topped up with the amounts withdrawn. And should you not use pot 2, you can move obviously all that money into pot 3 at retirement age without there being any tax implications. Remember, pot 3 cannot be accessed until retirement because Treasury want you to have money to look after yourself at retirement. This is going to create significant challenges for those people emigrating, because the full amount can only be withdrawn after 3 completed years of you being out the country. So that legislation came in on the 1st of March 2021. So we're at the point where the first lot of people are going to be able to draw their money, but very, very tough for people who want to emigrate, who are close to retirement age, but will not have access to their money because of this 3-year requirement. So we don't have all the answers, and those answers are going to come over time. One of those are, what are the rules if you're retrenched? I don't think there's going to be access to that money under those circumstances. The most important thing to probably note is, you know, if you're one of those employees that are wanting to draw money, you're going to be taxed at your marginal tax rates. So when I talk marginal tax rates, look at the tax tables and see where your annual salary is likely to fall, and you'll see a percentage. If that percentage is 18, 26, 31, 36, 41, 45, those are your marginal tax rates. So when you come to wanting to draw out of your savings pot, and your marginal tax rate is 31%, when they apply for the tax directive for this withdrawal, 31% is going to be withheld. So you're not getting, if you put in a claim for 250, you're not getting 250, you're going to get tax deducted and you're going to get expenses deducted. So please note that. The 550,000 exemption that I said to you that people above retirement age get if you're withdrawing from a retirement fund is not applicable in this case. And I think that's fair. That must only be used when you retire. And the funds tell us that it would not be beneficial to withdraw from the savings pot if you're close to retirement. Now, the biggest challenge that I see for you payroll administrators is the administration of these types of claims. If you've got a high blue collar employee count, you're going to have these blue collar people coming to your office and wanting to know how they can claim. I'm pretty sure that your retirement fund brokers and their administration staff are not going to assist or greatly assist in this place because of the administration and the burden of administration. But you as the employer are going to have to somehow make this happen. And as you know, with blue collar workers, every step of the process has to be explained, and it's unlikely that people are going to understand this process. So you're going to have unhappy people when they see tax that is deducted, and they're also going to be happy when they see that there's costs involved. As an indicator of the potential for claims, the 4 major retirement companies are looking at 20% of their investors making claims. So that's roughly 2 million people. I think that's probably going to mushroom as people see that they can have access to money. I think people generally are desperate. They're going to want to have access to their money, and they're not going to worry about retirement. We're going to see massive increases in tax directive traffic. Most of this traffic should be from your fund, though, applying for directives, but you're going to have to supply that fund with certain payroll information, annual remuneration as an example. And as I said, you're going to do training and have to deal with the emotional fallout with employees. One of the other challenges that you're going to have to deal with as the payroll administrator is explaining to the staff why they're not getting all their money if an AA88 is issued by SARS. Remember, if you owe SARS money, there's certain criteria or there's certain processes that they follow to get money from you. If you do not react to letters, emails, etc., WhatsApps or SMSs, when a directive is applied for on your behalf, SARS tells your employer, or they will tell the fund in this case, that they're issuing an AA88, and that is to say, this person owes us money, please deduct it from giving the employee. A lot of those are going to be for administration penalties, and being someone who does a lot of tax directives anyway, that creates a lot of unpleasantness, because employees will say, well, I've sorted this out with SARS, or I don't owe this, my returns are all in. That's got nothing to do with you as an employer. You as an employer, if you get an AA88 instruction, you have to deduct the amount, you have to pay it to SARS using the right reference, and the employee must go to SARS and deal with their challenges. Good luck, though, explaining that to a snarling employee. Some of the funds may not be as efficient as others, and this process might take a long time. It's not what we hear, but I suspect it will happen. There's no enrollment process. The funds will create this mechanism, but you need to actually, ask, because there is a process of moving funds, and I think it's on the next slide. Yes, it is. We'll chat about that shortly. But there are going to be some challenges in the savings to determine the savings pot in the case of a defined benefit. Remember, there is a defined contribution fund and a defined benefit fund. Determining the value that's going to go into this pot in the defined benefit is going to be obviously more complicated than the defined contribution. Quite importantly, there is a proposal that there's a cap to the maximum of 65% of an employee's retirement interest for things like home loans and that type of issue. So, although you want the employee to get the benefit of access to these funds for things like home loan coverage, at the same time, you don't want to jeopardize the contributions that are in the fund, because that money is actually there to provide them with a monthly pension on retirement. Now, going back to the previous issue, the questions regarding investment returns in the various pots. Obviously, the money that's in a savings pot, well, to me, it's obvious, is not going to get the same return as the money that's in the investment pot. So for me, as someone, closer to retirement than young people, I do not want a lot of money in a savings pot getting a low return. In fact, I'm in a position, thankfully, to not need to go to the savings pot. So I think employees need to be made aware, as soon as Treasury confirm this and the funds confirm this, what the return difference is going to be between the money in the savings pot and those in the pot 3, the retirement pot. There's supposed to be consultation between financial consultants and employees regarding the amount withdrawn out of the savings pot. So say you're coming close to retirement and you now need to decide what you're going to take out in cash. Remember, you can take a third out in cash. You don't necessarily want to do that unless you want to settle debt, and more expensive debt. You would generally consult with your broker and the funds. Are these funds going to avail themselves to come and talk to your employees that are wanting to make withdrawals? I very much doubt it. So there may be a hole there. Then the last point on the slide is ETR, UIF, COID, SDL will not be impacted by these, as the amounts that you're drawing from these funds are not remuneration. So it's not money paid by an employer to an employee. It's actually the employee's own money out of the fund. So there is a distinction between taxable income and remuneration. So just to repeat, remuneration is paid by an employer to employee. Taxable income in this case is money that they're receiving from a third party, namely the retirement fund. This slide just contains some IRP5 codes that are going to be applicable to this new process. You can look at that in your own time. Okay, now I'm going to move on to long service awards. I did cover this last year as well, but I've been inundated this year with this. Almost every single new payroll we take on, or any audit we do in the payroll space, this comes up because this is very badly dealt with. So I thought it would be beneficial to cover this again. And the first point to remember, the first time you can provide a taxable or tax-free benefit is 15 years unbroken service. So employee A works for 15 years of unbroken service. They then qualify for a 5,000 Rand exemption to anything that you give them as a reward for 15 years unbroken service. You then can provide another 5,000 Rand exemption every 10 years after the 15 years, okay, of unbroken service. So if you provided it 15 years, then the employee would qualify for another 5,000 exemption at 25, 35, 45, 55 years. If, for example, you give your first exemption at 20 years, then it would be 20 years, 30, 40, 50, 60. Okay. Now, prior to March 2022, this benefit had to be a form of an asset. That changed. The exemption can now be in cash. Remember, gift vouchers have always qualified as long service benefits, so you don't have to worry there. Krugerrands are assets, and the 5,000 Rand exemption could also apply to them. So in terms of the long service award calculation, have the long service conditions been met? Has the 15 years of unbroken service been met? Yes, it has. What is the value of the award? Let's say it's 5,000 Rand in cash. The value of that award can be reduced by the lower of its value and 5,000. So if I'm giving the employee 5,000 cash, the 5,000 is exempt. There would be no tax. If I gave the employee 10,000 in cash, only the first 5,000 would be exempt, and they would pay tax on the other 5,000. So we've got two IP5 codes to cater for this award. The first code is code 3622, and that relates to qualifying long service cash awards. So if you're going to give the employee 10,000 Rand in cash, you would have to put the 10,000 in 3622. Then SARS would reduce that by 5,000 on assessment to calculate the tax. If you gave the employee an award in terms of an asset, then you would use the fringe benefit code 3655. Sorry, 3835. Just to confirm, code 3835. If you're giving the employee both a cash award and an asset, then obviously SARS would look at the sum of those two awards and reduce them by 5,000 before calculating the tax. So the tax implications, to summarize, if the sum of the two codes is equal or less to 5,000, there'd be no taxable benefit. If they're greater than 5,000, then the amount over 5,000 becomes a taxable benefit. I've included a nice table here for you, just to give you all the options, so you can see the different types of benefits that you can give. It then shows you whether long service is applicable, and then it breaks it up into the codes and what is taxable and what is non-taxable. So just to look at the first one, in this case, the person's been given 8,000 Rand in cash. So code 3622 has to be used. Remember, only the first 5,000 is non-taxable, so 3,000 would be taxable. In the second scenario, the employee doesn't qualify for long service because they haven't met the 8,000 requirements. Sorry, the 15 years requirements, and they've given 8,000. So none of the 8,000 would qualify for the 5,000 exemption because they haven't met the 15-year or subsequent 10-year requirements. Okay. Then just one more, just quickly, if you're given the use of a company asset, this table is saying, yes, the person has met the 15 years requirements, and the value of this use of asset is 10,000. Remember, we have to use then code 3835 because it's a fringe benefit. And in this case, the first 5,000 is taxable because the other 5,000 is exempt. You can go through the rest of those in your own time. It's pretty self-explanatory. The even hotter topic is bursaries, so I'm going to quickly go through that. There's no earnings limits applicable if you give a bursary to an employee. If you're going to give a bursary to a relative employee, there's a thing called the remuneration proxy, and that is 600,000. Now, SARS deems 600,000 a suitable value under which they believe these employees should get benefits. If you earn more than 600,000, they're saying that you effectively privileged and you do not qualify for this exemption. So just to go through the scenario, you give an employee a bursary, there's no tax implications. If you give an employee a bursary to their child or a relative, then the 600,000 is your starting point. If they earn 500,000, great, they're under the 600,000. If they earn 700,000, sorry, they do not qualify. You do not have to even look at the exemption. Now, the term relative employee is important to note. They refer to family member who is under care and support. So it doesn't necessarily mean a blood relative. It means a family member who's under your care. So it's, you know, with the 600,000 being a limit, it's important to note that SARS are looking at certain sectors of the economy, but you as an employer can't only provide a bursary or scholarship to certain groups of employees. That would get you to the CCMA in 5 minutes. Just a reminder that a salary sacrifice can no longer be used to factor into an employee's salary. So what I'm saying there is, if the employee is earning 500,000 and the bursary is 100, you can't all of a sudden say, listen, we're going to reduce your salary by 100,000. We're going to give you a bursary to save you tax. That's called a salary sacrifice. That is illegal. What you could do, though, is if the employee is getting 100,000 an increase, say in lieu of an increase, we're going to give you a bursary. So it's important to understand the distinction there. You cannot take away from the existing salary. You can take away from the expected or the proposed salary. An issue that is very rarely dealt with correctly is the contractual relationship between the employer and the employee when it comes to such bursary. It's important that this be put in writing. It's important that the payback terms, the completion time, recourse should the employee fail, all these things need to be put in writing. There's as an example, if you give an employee a bursary, they fail, there is an obligation for them to pay back that money, and there is an obligation for you to treat that as a loan in the payroll, and that loan is subject to SARS subject to interest at the SARS rate. So important to put your understanding, your terms and conditions in writing for this to qualify as a bursary. Another table here just to give you an indication as to how bursaries work. You'll see the various categories in the bottom 4 lines. I just want to see if I've covered that. No, I haven't. So important to understand that if you give a bursary to a non-disabled relative of an employee and they're in grade R to 12, the first 20,000 is exempt. If that employee's child or relative is in higher education, the exemption is 60,000. So let's just take the first example of 20. If your employee's child is in grade 5 and you've given them 30,000 as a bursary for the year, only the first 20 is going to be exempt from tax and the other 10 is going to be taxed. Now, we've seen a lot of employers get into trouble here where they're overly generous and pay the school maybe 100,000 in January. Remember, your exemption is only 20, so the 80,000 is a fringe benefit. If you put the 80,000 fringe benefit into the payroll in January, the employee will take home no money. So what employers do is they create a loan. Remember, that loan has to have SARS interest at 9.25%. Otherwise, the payroll must calculate that interest and tax it as a fringe benefit. So be careful when you're setting that up. Now, if your relative is disabled and they're at school, the exemption goes from 20 to 30,000. And if they're in higher education, the exemption goes from 60 to 90,000 because they expect, obviously, expenses to be higher for a disabled person. And remember, the 600,000 is the starting point of this process. If you earn over 600,000, none of these exemptions would be applicable. This slide just shows you the RP5 codes. It's important to note that there's codes for the non-taxable and taxable portion. And obviously, if it's if it relates to foreign income, there's also foreign codes. You can look at that in your own time. And then this slide just gives you some scenarios. Let's just look at maybe them quickly, some of them quickly. Remember the 600,000 criteria. This employee earns 650,000. So immediately, this employee doesn't qualify for any exemption. So the 500, so any bursary that you give this employee would be fully taxable. In the second scenario, the exemption is 20. The employer gave the qualifying employee 35,000, so the difference of 15,000 becomes a taxable benefit. And and then the third scenario, although the employee qualified for a 60,000 exemption, the employee gave 45,000, so there's no tax implications. Okay, you can carry on looking at the other examples, they're all self-explanatory. Moving on to fringe benefits, I get quite a few queries on this topic. People saying to me, oh, but you know, what we want to do is we want to create a competitive environment in our organization, and we want to give people benefits. You know, at the end of the day, the decision-making process here is very, very clear. Is there employer-employee relationship? If there is, are you getting paid as a result of that relationship? Yes, you are. Then that whatever that payment or that benefit is remuneration, and it must be taxable. So a scenario where we're going to give a car away to the person in the group who comes up with the best sales strategy, SARS are going to be very, very clear. Whatever the market value of that car is going to be taken into that employee's taxable income as a fringe benefit. The fact that it wasn't as a result of their monthly pay, it's irrelevant. It's as a result of the relationship between the employer and the employee. Now, the only grey area is gifts. You know, flowers for your wife if she has a baby, a death in the family, etc. And generally, I think SARS would be harsh if they tax that as a fringe benefit. Travel allowances, yeah, something that's on the radar, something that's probably going to fall away in the next couple of years. And the reason it's going to fall away is because SARS know that this is one of the last true areas of abuse in the payroll process. And why? It's because employers insist on unduly giving travel allowances to employees who are not required to travel, or giving them travel allowances that are too high. So Giving an employee a travel allowance that's too high enables them to go away and become creative when they do their tax return, and to match their travel deduction to their travel allowance by putting in fictitious trips and getting a bigger tax deduction. So essentially the game is to match your travel allowance to your travel deduction, so you get all the tax that you paid on your travel allowance back. So employers must not artificially inflate the fixed travel allowance. The travel allowance must be allocated at a rate that is closely linked to the expenses that the employer thinks that the employee is going to incur in their travel. Obviously, the waters have been muddied significantly with employees now working from home. You know, where does business travel start? And you can bet your bottom dollar that SARS are going to be looking at this process and saying, hey, listen, you know, we've looked at your scenario. You live closer to your employees than where your office to your employees was. How come you're still claiming such high mileage? So it's just a matter of time before there is some sort of in-depth audit on taxpayers in this space. SARS are also looking to clamp down on the quality of logbooks. It's important that you put the detail that SARS requires. And when I talk about detail, where you went from and to, who you saw, the reason why you saw them is very important. And we have had cases in the last year where SARS have actually phoned clients to say, did you see someone on this date? It's really embarrassing if you've made that up. So, and obviously you're committing fraud if you do that. SARS believe that the employer should play a bigger role in the accuracy of logbooks. We've also seen significant differences. You know, if you're required to submit a logbook to your employer for travel reimbursement, and that logbook differs from the logbook you supplied SARS, it would be very easy to catch you as padding your logbook and committing fraud. Remember also that, you know, if the employee goes from a sales rep to the sales manager, and this requires a 50% drop in travel, SARS would be expecting to see a 50% drop in travel in a logbook. So just be careful. If you are going to provide an employee with a travel allowance, it's imperative that you have that in the employee's contract, either in the actual contract or as an addendum to the contract. In the absence of that, SARS could say that there's no contractual obligation to pay a travel allowance and tax it in full. So my parting shot there is employers will be held responsible for poor decision making and not following good practice in this space. Okay, this slide just gives you an example of what an employer could do in the case of how do you quantify travel allowance. Now, what employers generally do is they get pressurized into giving the employee what the employee wants, particularly new employees who have come across after being allowed to have bad habits in their previous employment. So what this slide does is it basically does a calculation to determine what your travel deduction is likely to be or allowed by SARS, and you can utilize that as the basis of your monthly travel allowance. Now, going back to one of the very first slides that I showed you, the travel table slide, that table is used in this process. So what you would do is, step one, the value of the car that the person drives is taken to that table, and we then take the fixed cost from that table, the fuel cost per kilometer and the maintenance, and we substitute it into this formula. So what we would need is we would need the cost of the vehicle from the employee. We would need an estimation of the total kilometers broken into private and business from the employee. We would then take the estimated kilometers, total kilometers traveled, and divide it by the fixed cost that we have from that travel table. So the fixed cost is applicable to all cars in the band. And then what we're doing is we're getting a fixed cost per kilometer. And all we're doing is then adding the fuel cost per kilometer and the maintenance cost per kilometer to that value to get a total cost per kilometer. And we're multiplying that by the total kilometers done to arrive at the total travel allowance for the year. Now, obviously, we just divide that by 12 to get a monthly. Now, what I've done here is I've just done an example for you. You can look at this in your own time, but this vehicle falls into the 250,000 bracket, and the fixed cost for a vehicle in that bracket is 89,119. The employee gives figures of 15,000 total mileage for the year. And as you can see, if you divide 15,000 into 89,119, you get R5.94.1 per kilometer. You add the fuel of 184 and 63.5 cents for maintenance, and you get a total of R8.41.6 per kilometer. And I'm multiplied by the business kilometers, but I know there's people out there who utilize the total kilometers to arrive at this annual value, and you divide that by 12 to get the monthly travel allowance. Okay, this table is very, very important. I had quite an interesting meeting yesterday with some clients who work for government and who are having massive travel problems because their employer is living in 2019 still. And this table just shows you the variables that are applicable in terms of must PAYE be deducted and what code must payments go to. Now, just in a nutshell, the R4.84 per kilometer is the SARS rate. We agreed that up front, right? If your employer pays you R4.84 or less per kilometer, with no limits to business kilometers, that transaction is processed to code 3703, and you pay tax-free, and you do not need to make any justification to SARS for your travel on assessment. The challenge comes in is if your employer pays more than R4.84 per kilometer, or pays you a fixed travel allowance and reimburses you, because then this nasty code 3702 comes into account. Now, although it's tax-free monthly, it is taxable on assessment. And we see cases where the employee comes back to the employer and says, listen, you guys are palookas because you're outsourcing to other palookas. I submitted my tax return and I owe 4,000 Rand. It's your fault. And when we go and we look, the employer is reimbursing the employee for more than R4.84. And as a result, code 3702 is applicable. And the employee has forgotten or doesn't know that because code 3702 is applicable, they need to submit a logbook on their tax return. They need to actually put in travel figures on their tax return. And hopefully the deduction equals what they've received and they don't owe money. But if you've got code 3702 on your tax return, on your IP5 on your tax return, and you do not put in travel mileage on your tax return, you are going to owe SARS money. There's a code 3722, and that was a new code introduced 2 years ago. And that code just deals with, on a monthly basis, if your employer pays you more than R4.84, some of it gets taxed monthly, but I'll go through an example shortly. So in this case, my clients work for governments, are getting reimbursed under R4.84 per kilometer. For some reason, the employer is fixated on this 8,000 kilometer limit that fell away in 2017 and are putting any reimbursements over 8,000 kilometers to code 3702 that was legislated and applicable in 2017. The employee thinks that because they're being reimbursed under the SARS rate, there's no requirement to submit anything on their tax return, and now are getting hit by SARS. So I sent them a nice email yesterday explaining the legislation, and they're going to be taking it up with their employer. Okay, so this table just shows you an application of how the codes work. Excuse me. In all cases, the employee's done 20,000 kilometers of business travel. In the first scenario, that they're getting reimbursed at $261. So your first decision has to be, is that above or below the SARS rate? Well, it's quite clearly below the SARS rate. So the reimbursement for the year, 52,200, goes to code 3703, non-taxable, and there's no tax reporting requirement. In the second scenario, they're getting reimbursed at the SARS rate. So exactly like the first scenario, they're getting reimbursed at or below the SARS rate. So they code 3703 is used. Scenario 3 is a little bit more complicated because in this case, the employee is getting reimbursed at R5. So first thing we notice, that's more than R484. So we're going to have to split codes here. Now, as I said to you, code 3702 is used if you paid over R484. But it's interesting to note that the amount that goes into code 3702 is only the R484 times the 20,000. The difference, which is 3,200, goes into that taxable code 3722, which is taxed monthly. Then in your own time, you can go down to scenario 3, 4, and 5, and 6. You can just look at those. It just shows you what happens when you introduce a travel allowance as well. But it's important for you to understand, to get into your head, the concept of the decision-making process in terms of above or below the SARS rate. Where does the reporting go? And what happens if you also get a travel allowance? Maybe let's just look at one with a travel allowance as well. The scenario where you get a 10,000 Rand travel allowance and you're getting reimbursed R261. Because you're getting reimbursed below the SARS rate, the full 52,200 goes to code 3702. But you're also getting a fixed travel allowance, so 80% of that is going to get taxed in the month. Excuse me. Remember the reimbursement rates is R484. We've discussed the excess rate. If your employer reimburses you over that rate, and remember that if you get a fixed travel allowance and a reimbursement, they're going to get combined on assessment. So don't overinflate your fixed travel allowance and then get reimbursed for every single kilometer from your employer, because there comes a point when that becomes inefficient and you might not be able to cover that income and owe SARS on assessment. Okay, moving on to additional PAYE deductions. This slide I included last year, but it's included this year again for the simple reason that this process is ongoing and we still get queries from people, particularly pensioners, to say, well, I've got this letter from SARS saying that I have to deduct more tax. Do I or don't I? Now, at this point, SARS will give you the option, but we are going to be moving to the point where SARS are going to want their pound of flesh in the tax year and not on assessment. Now, just to explain the challenge, if you as a pensioner are getting a pension from 3 different sources, all of those sources are going to tax you according to the tax tables as if that's your only income. Because remember, they don't know about the other sources. When you add that income together, the tax on let's just say it's 50,000 a month that you're getting. The tax on 50,000 is a lot more than the tax that would have been deducted from your 3 funds who paid you 10, 20 and 20. So you're going to owe money on assessment. Now, SARS have a challenge with that is because now on assessment you come and say, oh, I'm a pensioner, I can't afford it. Can I have a payment plan? That means SARS gets their money over a longer period and SARS spends more money on administration trying to collect that. So it is problematic. So SARS will give, based on your previous tax return, an instruction to the funds to say, listen, we know this guy's getting 50,000 a month. That falls into the 41% tax bracket. Please deduct 41% tax from every payment that you make to him, so that there's no money owing on assessment. The learnership tax incentive, that's been around a long time, as I said, from October 2021. It's was most recently extended to April 2024, but we have a good authority that's going to extend it to April 2027. So why is it getting extended? Because it's obviously working. Now, the leadership incentive was introduced to encourage skills development and job creation, particularly in certain areas. And there is criteria for claiming. And one of those criteria is submitting this RT 180 form, which I see quite regularly in the payroll environment, where we help people with this, with claims. Now, there has to be a lead employer. That lead employer has to be paying the employee remuneration, well, this learner remuneration. The incentive to the employer is an additional tax deduction. Now, remember, if you're paying this learner 10,000 Rand remuneration, you're claiming that as a deduction. This learnership tax incentive is an additional incentive over above that. And when the employer submits their tax return, they put in their actual expenses, and then they put in a claim for these additional allowance, well, this incentive to further reduce their taxable income. And the incentives are broken up into annual allowances. So every year that this person is in the scheme, qualifying scheme, there's an annual allowance that the employer can pay, then can claim, sorry. And then in the year that they complete this incentive, this process that the employer is following, this completion allowance is applicable. The value of the allowances differs depending on the NQF level of the learner. And as per bursaries, the same logic as bursaries, this allowance increases if the learner has a disability. As I mentioned earlier, the remuneration is subjected to normal PAYE legislation. So if you're paying the learner 10,000, the normal PAYE, UIF, SDL would apply. But you would have to also look to see whether you are paying the minimum wage in terms of the national minimum wage legislation. This is regularly overlooked. So this slide just shows you the learnerships, the NQF levels, as I said, whether the person's got a disability or not, and it's also broken up into the annual allowance and the completion allowance. That's all self-explanatory. You can look at that at your own time. An issue that comes up in almost every single audit that I do is the interest fringe benefit. Remember, there's legislation that says that if you are lending an employee money, or the employee owes you money because of bursary tax or anything, this legislation is applicable. And the tax benefit arises if you're obviously charging interest at a rate lower than the SARS official rate, which is 9.25%. But in a lot of cases, no interest is charged. So what would happen is the loan would have to be put into the payroll, so it's 100,000. The repayment period would have to be put in the payroll, so that's 12 months. And then our payroll administrator, or you as the payroll administrator, would have to put in what interest rates is being deducted. If interest is not being deducted, then the payroll system is going to work out what 9.25% of on that balance per month is, and it's going to tax that. So when the employee has this loan put into the payroll for them, and they're used to paying 1,000 Rand tax a month, all of a sudden they've got 1,100 Rands worth of tax. You would be able to show them that, look, because of the loan, we're not charging you interest, we are obliged to charge interest at the SARS rates, and because we're not, there's a fringe benefit. Remember, there are exceptions. Loans under 3,000 are not subject to this interest. Loans for study purposes, loans where your employer, in certain cases, allows you to buy low-cost housing, the mines, etc. Those loans are also exempt from this calculation. And a reminder that that rate is currently 9.25%, and that's been effective since June 2023. It goes up in the month after there's a repo rate increase. There's another slide that I had last year. It briefly covers employee transfers. I'm going to skip over that because we are running quite late. But one of the issues that I want to bring to your attention is employers can no longer just give an employee 1 month's tax-free basic salary to cover transfer rules. It's still happening. I don't know why, but because this practice fell away ages ago. In fact, it was March 2016 it fell away. So the employee has to prove actual costs. So the employee can spend within the company's policy, and I urge you to have a policy in this regard. The employee can spend or be given an advance and some sort of a tally up at some point. If they are transferred, they spend the money, the employer refunds them, or it's covered by the advance and a correction, and then the employer has to reflect that in the IRP5 under a certain code. I don't know if I remembered. I didn't put that code in, but sorry, let me just check if that yes, they're the codes. So qualifying expenses will go to code 3714. Non-qualifying expenses go to other allowances 3713. So if you are paying the employee any transfer costs, you still have to report them in the payroll. Don't forget that. Moving on to UIF compliance certificates. This is an unmitigated disaster still. You'll remember that the online system was implemented in 2021. It was fantastic. You could put in your details and electronically get given the certificate. That soon became a problem because every single submission was rejected. We had rejections from all over. Employers that were compliant forever all of a sudden became non-compliant. I've seen problems go back to the 1970s according to the UIF legislation. Old ID numbers created confusion. Every single time we submitted, there was a new error of some sort. And we could never get feedback from the Department of Labour, UIF, as to what was going wrong. So there was challenges. Employers were bleating that they couldn't apply for tenders because they needed this certificate. The payroll authors group got involved. There was so much stress, and at the 11th hour, Department of Labour, UIF, conceded that these certificates could not be issued because they couldn't fix the errors, and they issued a letter, which is in the following slide, to say, if you are required to have the certificate for a tender, just send them this attached letter. So the pressure was off. We were then told that there would be some sort of an interim submission process introduced. That hasn't happened. So it's still a disaster. The Department of Labour has been threatening for some time to move to a new system that would prevent all these errors. They've said that there would be improvements in the bulk upload facility. Validation issues would be solved. Yeah, absolutely nothing has happened. In fact, the last meeting with the Department of Labour was in February 2023, and no progress has been made. So you can understand how frustrating that is for the payroll authors group, who are representing all of us. Here's that copy of that letter. If you need that letter, I would be happy to email it to you. In terms of monthly declaration changes, I pull my hair out. We get notifications from our clients all the time that the employees can't get benefits and it's our fault and we're useless. We get lots of queries from companies who help employees with claims saying submissions are missing. There's random submissions missing here and there, all very confusing. So there are challenges. One of those challenges is foreigners. We can't submit a declaration file with a foreigner's passport number on. Foreigners' details have to be submitted separately on new filing, and that accepts the maximum of 50 records. So huge problems. We can't do bulk uploads. We have issues where domestics have multiple employers. When it comes to claims, we can't do claims. As I said, declarations are missing. We've got proof that declarations were made. We've got an email back from them, but service providers send feedback from Labour saying submissions are missing, so we do resubmissions. So this is not easy to comply, and unfortunately, you need to stay patient. I will keep you up to date as things change, because as I said, I am on that payroll authors group board. In terms of domestics, if you haven't registered your domestic for UIF, you're going to be in trouble. This slide just shows deductions that are allowable and what deductions are not allowable from a domestic's salary. So, you know, if you have agreed a medical insurance with the domestic, you can deduct their portion off. Savings and loans, garnishee orders, if there's a court order, can come off. But the domestic is protected. You can't deduct more than 25% of their salary for these various issues. You know, if they've broken stuff or you provide meals and uniforms, you can't deduct that off their salary. I know some employers do. And any cost for work equipment can also not be deducted from their salary. Moving on to COID. We're going into COID filing season on the 1st of April, so hold on to your hats. There's a COID threshold every year, and that COID threshold is for the year starting on 1st of March, 597,328. So that means your payroll system will only calculate the COID provision up to that value. Payroll systems are designed to calculate reports. So if you have got your COID risk percentage, please provide it to your payroll administrator to put into payroll. So that will create the correct provision and show you how much you're likely to pay COID for the year. Those COID reports are obviously used for the annual return of earnings process. It's important to remember that you, when you do this annual return of earnings, that you have to include permanent, temporary, and casual employees. It must also include learners or students, anyone there for work experience, and any employees outside. Anyone you got in your employee who are not on the payroll, you are making a big mistake if you don't have them in your return of earnings, because if something happens to them, there's going to be a civil claim against you. Whereas if you registered for COID, COID will pay. The return of earning online system will go down basically for this next 2 weeks to enable them to prep. And as I said to you, from the 1st of April to the 30th of June, we're going to be in full swing submitting return of earnings. Late submissions incur a 10% penalty. Going back to domestics, there was a Concord ruling a year or two ago that said domestics are employees and are to be included in the COID system. I've done very few COID registrations for domestic employers. Remember, you're obliged to by law. If the employee is killed or injured or becomes sick on duty, you're going to get a civil claim if you're not registered for COID. The minimum assessment for COID domestic employers is 498 Rand. And quite ridiculously, the legislation makes provision for claims going back to 1994. We're seeing lots of audits in the COID space. very expensive audits. So be careful. The COID threshold, we've seen lots of errors in the COID threshold. Just to advise you that 597,000. Previously, what payroll systems did is they divided that by 12, and they limited your COID provision to 1/12. Now, what the legislation actually says is it's an annual limit. So if you're earning 200,000 a month, you have paid your COID threshold in the first 3 months. That creates a lot of problems for executives who payroll hop. You could have those people on multiple payrolls subject to COID. Every separate registered company, so if you've got companies in a group, you can't just register the group. Every separate company has to be registered for COID. And remember that the COID commissioner can estimate if you do not submit. And let me tell you, if there's an estimation, it'll take you 3 to 5 years to fix that estimate. Here's just what the legislation says in terms of inclusions and exclusions in COID remuneration. The legislation is changing. It hasn't been promulgated yet, but we have it on good authority that it'll be backdated to the 1st of March. And from the 1st of March 2024, COID remuneration is going to be the same as taxable remuneration. So we're going to have a lot more earnings brought into the COID threshold. One of the touch points, sorry, before I close on COID, is overtime. And that word regular, this is where the auditors are having a field day with clients, is what is regular. And what they're saying is if you are paid overtime for more than 6 periods in the 12-month period, you're a regular overtime recipient, and your earnings must be included in COID earnings. Now, most payroll systems have, until this point, excluded overtime completely. So we're in the process of consulting with our clients to ensure that, do they pay overtime? If they do, is it regular overtime? Those employees that are earning regular overtime, that's going to manually be added in. But if we're not doing your COID return, this is a process that you're going to have to look at yourself. Happy to help guide you if you do fall into that category. Then the BCA threshold change, that goes up every year. That's gone up marginally from 224,000 to 254,371.67. That's effective from the 1st of April. And in a nutshell, that determines an employee's entitlement to those issues covered in the bullet points. But most of you will understand this to be the threshold at which overtime is no longer required to be paid. The national minimum wage, important to note that as of 2nd of February, the national minimum wage went up to 27.58 per hour, and that is applicable to all individuals except public works people, and their minimum wage is 15.16. That's one of the reasons why we've had major strikes in eThekwini, because those people are doing similar jobs for wildly different rates per hour. This slide shows you the minimum wage applicable to learners. Please look at that in your own time. The BCA defines an employee to exclude independent contractors, but the minimum wage does not exclude independent contractors. So if you've got independent contractors earning under the minimum wage, you would have to increase that. This slide just shows you the definition of an employee and the term wage in terms of the National Minimum Wage Act. You are going to hear from us in terms of some recent court cases in the space where inclusions have been made into the definition of wage that do not agree with the definition of wage in terms of the basic conditions. So particularly in the place of bonus of bonuses, but there will be some notifications going out. PAYE and Public Access to Promotion to Access to Information Act. Sorry, just a slide on PAYE. There's going to be some tweaks to the legislation to stop unsolicited emails and random calls. I'll be very grateful when that happens. I'm sure you all will. And just to tell you, the information officer is a highly stressed position when it comes to this, particularly if you've got access to a lot of people's private information. The reporting is quite onerous when there are challenges. SARS update, just quickly. How wealth individuals are under SARS focus. SARS are employing hundreds of IT people to use AI and data analytic tools. So you're going to see less people on the ground, but you're going to see more letters flying at you coming out of these tools, and they're going to identify irregularities, fluctuations. So, yeah, as I said before, hold on to your hat. We've also seen this traveller management system tested. So they're going to know who comes in and out of the country, and you're going to be asked to explain your movements. SARS are looking at APIs to move data. So large sums of data are going to be dumped into SARS systems, and these tools are going to be applied to it. And then the enhanced tax directive process is an ongoing process. This slide talks about the SARS BRS, so the business requirements specification. You can have a look at this in your own time. It just talks about changes to the various fields. The majority of this is covered in your by your outsourced service provider. And just to note that on the 16th of September 2024, the filing season for the interim submission will open, and it will close on 31st of October 2024. Here's your new RP5 codes, long service, and your two-pot will be in there. There's your two-pot RP5 codes. You can look at those in your own time. Just some quick information on interpretation notes that are in draft. The most important one is one that refers to the responsibilities to withhold employees' tax. That has always been on the employer. If the employer doesn't do that, SARS will come for you for their tax. It's important to note that SARS can also go for the employee. So you'll have a very, very unhappy employer if you haven't deducted tax and SARS goes to the employee for tax. So just note that. This is also a piece of legislation in permanent work in progress, section 7B, capital B. Remuneration should be taxed on accrual or receipt. The exception is variable income, and that is taxed when it's paid. So commission is an example. You'll only know what the commission is the month or two after when stats are known. So you are not required to go back and include the commission in the month that it's applicable to you. You can tax the commission when it's paid. These issues are important to note when monthly RP5 submissions kick in. Residents and non-residents, just you could have a look at this in your own time, but briefly, we're seeing a lot of more South Africans are in a position where they're working for foreign employers, and PAYE is not being deducted on a monthly basis. So what this legislation is saying, those employers are going to have to be registered in South Africa for PAYE purposes, and PAYE is going to be deducted. We can assist in that process. And what happens is we register you as an external employer. We register you for PAYE, UIF, SDL, COID. And what happens is you do not have to submit financials, but you have to obviously deduct PAYE and all of that. So quite interesting. SARS obviously not trusting you to pay provisional tax. And at the moment, we do this for quite a few companies that are based in Australia and the UK, and it works quite well. High-level employees who these foreign companies deem to get better value from South Africa. Okay, so retirement funds, just an important point. Remember the 350,000 cap. This cap must be spread over the year and not utilized at once. And we have seen an anomaly where if a person immigrates, it's important to remember the day they immigrate, it starts a new tax year. So you can often see, well, if they immigrate, that they have 2 tax years in one. And, you know, prior to SARS tightening their ship, they would get this 350,000 retirement cap in each year. And that obviously wasn't the intention. So that has been changed as well. I think, you know, personal income tax, monthly submissions. Yeah, very, very touchy subject. PAYE have been dealing with this for some time now. And the bad news is going forward, you are going to be doing monthly RP5 submissions. And PAYE have been trying to get to the bottom of what SARS intention is and what SARS want to see. So SARS are requiring these uploads from various sources. So they're going to know literally on a monthly basis what each employee is earning. And they're talking about a monthly account. The employee will be able to log on and see a monthly account of their tax liability, rather than this all coming together on their tax return and an amount being owed on assessment. We know that the final calculation is done on assessment, but you know, on a monthly basis, SARS will be able to notify people to deduct more tax so that there's not a big lump sum owing on assessment. That'll be applicable mainly to people who have multiple sources of income. The challenges to the payroll companies is obviously SARS wants more RP5 information. Most payroll systems can produce that information, but PAYE, as an example, as PAYE have unpacked this process, more and more challenges, practical challenges of coming out, have shown that this is not as easy as SARS believe it is. Submissions have been made, practical examples have been supplied, and SARS are mulling over these submissions as we speak. Okay, we're at the end. I'm sorry that that took a little bit longer than I'd hoped, but yeah, we're gonna unmute and you are welcome to ask me questions. If you don't want to ask questions, you're welcome to send me an email to Dave, D-A-V-E, at HRTORQUE.co.za. If you forget my email address, you're welcome to send an email to the organizers and they will send it through to me. But at this point, are there any questions? You can raise your hand and Shabs will unmute you. Charles, sorry. Charles, any questions? Okay, so yeah, no questions. As I said, I'm sorry it took a little bit longer, but lots to think of. We will distribute the slides, and yeah, I'll put my email address at the end of the slides, and yeah, just feel free to ask. always better to ask than not ask, and then get into trouble. And I do have a pretty unique insights, having worked on both sides of the fence. But thank you for your time. Thank you for your interest, and have a fantastic day and a great long weekend.